Yeah, welcome back. Probably this is the last part in this particular topic on fundraising with respect to setting up the business. Uh, so this is not a recap of what we discussed so far. We discussed about all the four options, the critical factors, and the complexities. Now, what we are going to discuss is the important notes which you need to take into consideration about how certain things work really, on the field. First thing, as we discussed, it is about shareholders agreement. And here, one of the important point which you need to remember is that the purpose of getting the fund should match with the effort you are going to put with say suppose you are trying to get the fund for setting up a new geography, then the effort should be funded by that. You cannot use this fund for some other purpose. The same way, for example, you are trying to buy equipments and you are seeking funds for that, then the fund should be utilized only for procuring those equipments. So the investors will be very careful. Sometimes they may ask you to have a separate books and with all the controls in place. So here, the importance is that the purpose of the fund has to be, matched with your actions. For that is the, that is the important point. Second thing is, whether you are going to be revenue centric or it is going to be cost centric, as a design of the company. Okay. So here, if you are going to be revenue centric, then you need to have the entire CRM cycle, starting from identifying an opportunity to getting a prospect to customer. That entire cycle you should keep record of, and you can there are a lot of CRM tools available, and you need to make sure that the you use the tools correctly, so that at any point in time, your amount of truth respect to your customers or prospects, and they are the one who are going to give you revenue, right? So with respect to revenue, you can map here. This actually, will lead to pipeline. So then you can even plan for how the pipeline is. Like you may have so many opportunities, gradually tapering down to is a funneling effect. Then finally, only a few will turn out to be a customer. So the ratio of prospect to customer, or opportunity to prospects, opportunity to customer, everything it can be worked out. So your pipeline is very very important. And here you also need to remember that what is the time and the cost. Of course, cost includes time, and what is the cost involved in acquiring a customer. You may have your own sales cycle. You may have the customer may have different cycle, purchase cycle. So here the essence is that the buyer's purchase cycle and the seller's sales cycle, they have to meet at some point in time. That is the real essence in the sales. So how much knowledge you have with respect to the customer and the customer's business practices or the industry practices in which the customer is in, and that need to be mapped to your sales cycle. So the cost to acquire customer is very important from the revenue or sales side. From the cost side, everything is an expense, and how far you are able to leverage this cost to acquire your customer, thereby revenue. So these are the other two factors you need to consider. Third thing is, normally when you seek loan for this, many people will demand a collateral, and you cannot assume that you have a $1 million property, or 5 crore rupee worth of a property they will give. Or if you are generating X crores of revenue or X dollars of revenue, that I mean the lender won't go by that. Normally they will take only the 20% of the market value of the collateral, or your last sale, or no the average of last three sales. or the moving average of last 5 sales. It can be any of that, and whichever is the least only they will give you. So don't assume that whatever is your loan amount, somebody is bound to give you. That may not happen, at least in a structured setup. Uh, Maybe in an unstructured setup or in an unorganized sector, probably you may get loan. But in organized sector, that is very difficult unless otherwise there is a scheme available from the bank or from the government. And the other important point, the fourth important point in this topic is we discussed about the return of capital and return on capital. So your projections, your revenue projections should go at least 30 to 50% beyond the sum of these two at any point in time. Otherwise, what will happen is that I give you, X rupees or dollars to you, and you are going to return all that. Then what will you do with for your life? Your life meaning not only director's life, the operations of the company and the salaries and the welfare of the staff, etc. So you always need to plan 30 to 50% on top of the sum of revenue on capital or revenue on investment and return on investment or return of the capital. So you need to plan for that. The next important or the best practices I would say is that whatever is your expenditure, whether you are going to spend on salary or on equipment or on land or anything, even petty cash to that extent, there should be a corresponding revenue source which you have to map. This is like this is like a fund mapping, as people would call. So you need to have a fund mapping setup so that every cost should be sponsored within quote sponsored by a revenue stream of your organization. It can be sometimes it can be a capital also, that I agree, but any I mean you take fund in general. So all the expenses should be matched to uh, some fund or other. I mean, and that means only when that fund arises, that expenses should be done. And if that's where you have to seek fund carefully. So your expenses is very long term, and whereas your fund requirement is short term and it's a smaller chunk or is a fraction of your expenses, then very highly likely that you are going to be doomed. Okay, so you need to plan, your financials. Definitely, if you are a financial controller, you can plan this. So you need to plan that. The essence here is that you have to map all your expenses with your funding source. The next important point, which people try to avoid sometimes or many times rather, is that traceability. Traceability, we discussed in one of the videos related to manufacturing, but purely from a technology and the other part of it, but not necessarily so. It can be even applied to a self. But here in the context of business, it's highly essential that you need to map everything to everything else. Okay, that is the traceability, so that at any point in time you can have a 360-degree view of any of the expenses to any of the revenues and how they perform. Here there may be a small catch, like you may have to organize yourself, which people may not like to do or not tend to do or may feel that is a waste of time. But if you don't do, what will happen is that down the line, now when you get investment or the subsequent investments, as people call as Series A, Series B kind of a thing, then it will be very difficult for you to even justify yourself, or there is a possibility that you may lose certain money by way of poor operations. So, yeah, traceability is very, very important. And one word of caution here is that the people try to jack up the price value of the company or book value of the company, and by knowing certain information well in advance, whether it is a private limited company or a public limited company, wherever there is a share involved, as per the law, insider trading is punishable by law in almost every country I know of. So, uh, but you need to understand what this means by insider trading, so that you don't get into that space. So that is a caution. And one last point on this subject. which is very, very vital, and that's why I'm just reserving it for the last part of the story. The founder or the owner or whoever is the who are all the board members, for example, or who are all the key personnel like managing directors or the board of directors, whoever they are, when they go for funding, equity funding, besides all these things, whatever we discussed so far, the incoming investor would definitely expect, if the director of the company or the board does not know the business, or business in the sense, we talked about both the revenue side, cost side, including capital raising, everything, the entire the traceability, whatever that is for that company. If that director or the owner or the entrepreneur does not know, please remember, if the person does not know, the incoming investor would expect whether the entrepreneur is coachable or not. If you are not going to listen to what I am saying, then irrespective of whether it is profitable or non-profitable, uh, the investor will turn cold, which means that the expectation from the investor is that the entrepreneur should be willing to listen to what the new incoming funder says, or whoever he is referring to, like an advisor or a consultant, whoever it is. If he is he must be willing to listen, and he must be willing to do certain things which is expected to be done by the entrepreneur. Otherwise, it will be very difficult for the incoming person to do business with you. With that note, we have covered in 4 parts about fundraising options. I'll see you in the upcoming videos on other topics related to both business and about manufacturing. Thank you for watching. This is Gokul.